Alright, we're going to take a look at some stocks tonight that reported earnings, as we love to do. I'll post these in the morning because obviously it's a little bit later. Late day at work, so didn't get home in time to post these same day, so we'll post them tomorrow morning, or really it's just this morning, but the morning after these earnings reports. Hopefully we can see where these stocks end up. Some of these moved a little big, but we're going to start with Lyft. Definitely a very highly anticipated one after we saw what Uber was able to do last week, I should say. It was a pretty bad earnings report, I can't lie. Now, my concern with Lyft was going to be the fact that they are even less diversified, right? Uber at least has the food delivery segment, whereas Lyft is pretty much solely relegated just to the drive segment. So it's all focused on ride sharing. And as you notice from Uber's earnings, ride sharing is an industry that is completely jacked, and I've called it out for a while now. Ride sharing is going to be messed up for a long time after this event too. There's a lot of concern with obviously just going in a stranger's car as far as safety sanitation is concerned, that is affecting a very, very large portion of the ride sharing business, and it probably will for at least a year now. Which is really bad for companies like Lyft and Uber that are just massive negative money earners, right? They lose money hand over fist, and this is a bad environment for them because it only increases that loss. So I want to take a look at these earnings and see what we're seeing. And if you looked at my earnings reports to watch, I told you I expected an over 50% decline in revenue. And what can you say? You look at the earnings, you see a revenue of $339 million, declines by 60.9%. That's right, misses by $10 million. So not unexpected there. I expected a greater than 50% loss. So pretty much in line with my expectations on the matter. Not too much of a miss. 10 million, not the end of the world. GAAP EPS of negative $1.41 did beat by 10 cents, but net loss was $265 million when you only brought in revenue of $339 million. Is pretty scary, right? Definitely pretty scary to see. Contribution margin fell pretty massively. Revenue per active riders did actually rise as opposed to what was expected. So revenue per active rider did go up. I think that's entirely because there were less active riders. So those that used it more regularly added more revenue, in my opinion. That's my perspective on the matter. So less casual users that were only using it for small trips here and there aren't using the app or the service as much. So that way you're sticking to the dedicateds. The company will be among the first ones to benefit when the economies open up. Says this. They've been adding articles in these posts now, which I don't know about. Looking at a little more detail, revenue fell 61%. Lyft says rides were up 78% in July compared to the lows of April, but still overall my assumption is that is lower year over year still. So it did plunge from April, but still not leveled out, and it probably won't be for a while. Active riders plunged 60% year over year to 8.7 million, below the 10.5 million consensus. I mean, with numbers like this, it shocks me the stock's where it's at. And again, it is down 30% on the year, but it shocks me the stock only fell down just slightly after hours with numbers like these. Revenue per active user dipped 2% only, which is good. But again, it's because my theory there of less active riders meaning more revenue per user, right? So, adjusted EBITDA loss of $280 million, lower than the guidance of $325 million loss expected, and the consensus of $290. So nice there. They were nice enough to provide some slides for us, which we'll go over. I don't know if I've ever been more tired in my life. So for highlights, they want to say that 95% growth in ride-sharing rides during the week that ended July 22nd versus the week that ended April 12th, which is their lowest possible week. And they're saying that July showed a 95% recovery, so nearly double the rides, but still overall active users plunged 60% this quarter. So they can say it's positive in that aspect, but I just don't know if I buy it. Yeah, I don't know. I don't quite know if I'm buying it. So they talk about their response to everything going on. Key financial metrics, you see overall, year over year, the revenue fell massively as we expected, and loss increased quite a bit. Oh my gosh, my calf just locked up like no one's business. The whole thing turned to stone, and I felt like I was going to have to cut off my leg. But we're good now. Here you see the revenue per active rider. Not too bad there. And active riders, you see the massive plunge. The question is, when's that recovery going to happen? I mean, they talk about recovery, change in rideshare year over year. You see a slow recovery. Even in July, they were a 54% year-over-year decline. So you do need to mention that at some point that rate is even going to slow down, I think, as the recovery slows. I don't think it's going to be a fast recovery. But even at the pace they're saying, of what seems to be around 8% every quarter, 7 to 8% every month, I should say, that's still going to take a long time, right? I mean, I don't know about you, but it looks like just from their estimates, we're going to be waiting another 8 months before we even see recovery from the 2019 levels, which is not a good sign. 8 months, I don't know about you, but that's not a good time to wait for a stock showing declining revenues. You know, that's my perspective. So, insurance transactions, not necessarily something I care much about the company, but I do want to cover the balance sheet here, because we love to do it with the balance sheet. And this is a very in-depth one as we zoom in just a little bit, because we like to see, we zoom in a lot of bit for you guys, okay? Don't say I don't do it for you. Don't say I don't do it for you. We're looking on the far right here. We can compare it to whatever we really want, but overall, you did see, overall, nothing crazy. Total assets hasn't changed much quarter over quarter. Total assets in general, though, has seen a decline since Q2 of 2019. Not by too much, $500 million. Right now it's at $5.2 billion in total assets. Liabilities, you see overall liabilities of $2.9 billion. Now that number has risen actually in that time since 2019 by around $500 million as well. So assets have declined by $500 million, and deficit or debt or liabilities has risen, says by $500 million. So definitely something you need to note there. That's $1 billion difference in stockholder equities, you see. So overall stockholder equity, you can see they did progress finally in Q2 of last year to an actual stockholder equity, but we've seen decline every quarter since, and next quarter is going to be more of the same, and we're going to see the stockholder equity continue to fall. It is good that they've seen positive, but this balance sheet's not a beautiful one in my opinion as far as the current environment's concerned, because it's not a good environment for this company, and it won't be for several quarters. So I just couldn't imagine putting money into this stock right now, even trading at a market cap of $9 billion, when this year they're likely only going to put up, close to a, let's be fair, they'll probably put up, if we're being generous, which, let's be generous, okay? They'll put up $1.5 billion in revenue this year. Potentially 2 max, and obviously that's not trading too high as a multiple compared to the market cap, but just not for a company that I don't trust of what this recovery looks like. And as far as just that balance sheet, it's scary. It's scary for me, because it's going to get worse, right? It's going to get worse before it gets better for this company. So that's what I got to say, and I'm not going to fall asleep quite yet.